right, great. Thanks, Gabrielle. And you should be able to see the screen. Excellent. So we'll get started here, and that'll work. Okay, welcome. So normally, for quite a while now, we get on and we go over the live charts, and we set up trades and review those trades and take trades and all that, all based off of our core strategy, market timing strategy. But over the past couple months, I've had more and more questions come in, and it made me realize that, you know, we haven't done a session that's purely lesson-based in quite a long time. So I thought we would do that today, and we'll perhaps get to the live markets in a little bit. But I think, you know, the most important thing, we can go over live markets constantly. The most important thing is you really understand and learn this the right way. So I'll do my best job to convey this market timing message to you today. And let's begin. We'll certainly focus on FX today, but just understand that everything we're going to talk about works in any time frame, in any asset class, stocks, futures, Forex, certainly a huge part of options. So you can see the title of the session here, Why FX Banks Make Money and You Don't. Now that's not to suggest that nobody makes money and only banks make money. But the reality is, it's pretty clear that, you know, I don't think we need to hide it, right? Many retail traders, right, like you and I, don't do very well. I mean, what's the success rate of an average FX retail trader? Not great. At the same time, you know, big banks and institutions tend to do pretty well. Yet both groups are buying and selling in the exact same market. So why is that? Why is the gap so wide between, you know, big, consistently profitable banks and, you know, kind of novice retail traders? I want to take you back a little bit. So, understand too, one more really important thing. So I'm going to go over as much as we can today, but understand, you know, this is, you know, 40, 45 minutes together. This is not the full-blown, you know, 7-day course at Online Trading Academy. It's not the, you know, the trading rooms that people are in for quite a long time, but I'm certainly going to give you my best effort here. I can promise you that. Okay. Well, I'm going to explain it all to you here, Ray and Shawkat. So I started my career not as a trader, not as a retail trader, certainly not as an educator. That came way later. But I started on the institution side of the business, the big bank side of the business. And I also started on the floor of the Chicago Mercantile Exchange, right, back in the heyday of floor trading in the 90s. So, and the most important part of my education, and there's a reason, you know, I'm telling you a little bit about my history because it's going to help you understand strategy as we get into that in a few minutes. So I started on the floor of an exchange working on the institution side of the business, not the retail side of the business. And I had no experience. And I will tell you, you know, looking back today, that was the biggest benefit I could have had. Learning this the right way from the beginning was absolutely key. It was critical to, you know, the learning process, learning the right way. So I would get down to the floor, and I actually started in the currencies. Right? CME back then had 2 floors, currencies on one floor and pretty much everything else on another. So I get down to the floor about an hour before the markets get going. That's kind of what the trading floor looked like right there. And I would be taking orders from banks, institutions, money managers, hedge funds, you name it. And big orders, right? Limit orders, buy and sell orders. You didn't have the euro back then. You had the Deutschmark and all the others, right? Pounds, yen, everything. And about, I'd say, 10, 15 minutes before the markets would really get going, you stop answering the phones. You stop taking these orders because you have all these, you know, this big mess of unorganized paper in front of you. So you create stacks of orders, piles of orders, all according to price. Okay? Put the buy orders to my left. Okay? And let me just get you to this. Put the buy orders to my left and the sell orders to my right, and off we would go. Now, one thing I didn't need anybody to tell me, is how and why prices turned in a market and where prices would turn in a market. I can tell you that and be right almost always. Why? Because I had some of the biggest orders in the world in front of me, right? And I had Morgan Stanley over directly to my right and other big banks and institutions all around me, and everybody had very similar orders. Okay. For example, if I wanted to know where the Japanese yen was going to turn low, was going to stop falling and turn higher, I'd look down and to my left and find a larger stack of buy orders below current price. That was the market's real demand. Okay, just like this. If I want to know where the market was going to stop rallying and turn lower, I'd look down to my right and find a larger stack of sell orders above current price. That was the market's real supply. And all prices would do every day, just like they do today. They go from demand to supply and back again until all the orders in that stack of orders are filled, and price quickly shoots to the next stack of orders. That's all that happened back then. That's all that happens today. That's how it's always worked, and that's how it always will work. It's pure supply and demand in the market. Now, as I'm saying this, you may be thinking today, the bids and offers, supply demand, it's very easy to see for screen-based traders. You may be thinking because you see it in the form of bids and offers on your trading screens. Let me make sure you understand that's not what I'm talking about. I would argue that those bids and offers that you see on your screen are not exactly real. Now, how do I know that? First of all, how many times a day do you see the bid like 10 times the size of the offer and prices fall? Or the offer like 10 times the size of the bid and prices rally? Happens all the time. Stocks, futures, FX for sure. How could that happen if those numbers are real? Well, that information is not exactly real. Are those numbers there and are those numbers real? Yeah. But are the intentions real? No. Now, how do I know that the orders that I was dealing with on the floor of the exchange were real? These orders that I'm showing you here, real demand and real supply. First of all, it was completely illegal for me to trade my own account, number one. Number two, there's cameras pointed at you from every direction. It's like worse than a casino. There's the phone lines are recorded. You hear the beep every few minutes, and on and on and on. So my question, my point is, why was there so much security and scrutiny around what I was doing? After all, I was just a phone clerk at the time. It wasn't like I was making millions of dollars. Why was there so much security around? It's because what I had access to was the market's real willing buyers and real willing sellers, and the biggest in the world, right? Some of the biggest buy and sell orders in those markets were right in front of me at my fingertips. And my question to you is, if you have access to that information, where banks are really buying and where banks are really selling, do you need anything else? Is there anything else you need in your decision-making process or any other tool you need? No. Exactly. I agree. So that alone is the focus of our lesson today, and that's at the heart of our strategy. Okay. Today we don't see paper orders, right? And certainly screen-based bids and offers not only don't show us what we need to see, most of the time they show us the opposite of what we need to see. So how do we make sense of all this? Understand the whole supply-demand 101 concept. When we look at a chart, it's that same picture, just sideways. Okay. And we're going to get pretty deep into strategy. Don't worry about that. But when we look at a chart, okay, it's the same. You have to be able to see the same supply-demand concept, only it's sideways. All right. Now, I want to expose you to some pretty important information here. Some things you have to wrap your head around in order to get this. These orders that I'm showing you on the right side of the screen, right? Are these filled orders or unfilled orders? The supply-demand, the stacks of orders here. Have those trades happened yet? They're unfilled, correct. Okay, those are unfilled orders. Now, understand that the only thing that causes prices to turn in a market and move in a market are unfilled orders. Would we all agree with that? Does everybody agree that the only thing that causes prices to turn and move in markets are unfilled orders? Anybody disagree with that? I just want to make sure we're all on the same page. Right, we all agree. Here's the problem, okay? The chart What does the chart show us? Filled orders or unfilled orders? The price chart shows us filled orders. Whether you're looking at a candlestick chart, line chart, bar chart, point figure chart, volume, any kind of chart you can possibly come up with on every platform out there, they show you filled orders. Okay? Not only are we, not looking for filled orders, but we're looking for the opposite of that. Does everybody kind of see so again, when you think about the concept of, why are individual retail traders so bad at this, and why are banks so good at this? Can you start to see why the gap is so wide? All banks are looking at are unfilled orders. Retail traders looking at the opposite. That's a pretty big advantage. Does that make sense? There's other reasons why the gap is so wide, but that's a big one. So, now the good news is you can do a pretty good job of identifying key unfilled orders on a price chart if you know what you're looking for. So we'll move on in a second. Your eye, okay, when you're looking at a chart, your eyes are going to see, candles or bars or whatever you're looking at. Your eyes are going to see this, what you're looking at on the screen here. But when your eyes see this, your brain needs to process this. Does that make sense? Okay. Now, this little concept we just talked about here, again, it's not in trading books or anything, but it's very important for you to understand that. Most traders that just, live on trading books and webinars and stuff, they're never going to come close to realizing that basic concept, but it's a pretty big thing. So we need to be able to look at a price chart that shows us filled orders and figure out where the unfilled orders are. Here's a trade we took a while back in the Japanese yen, just identifying a price level where supply exceeded demand, where banks were selling, and we sold there too. But let's back up here and go over this concept. So we need to be able to see the two groups on a price chart. Okay. Banks and institutions and retail traders. They both have very different footprints. You need to be able to identify the difference in those footprints. Let's do that. So in the short period of time we have together today, I figured, I thought the two things I could cover that will help you, at least start to really help you understand this market timing concept are right here. And we're going to dive into the chart in a second. Number one, we're going to start to learn how to identify those key supply and demand levels, specifically where banks and institutions are buying and selling in the market. And number two, we're going to learn to identify the footprints of banks and the footprints of retail traders, because you need to understand who is on the other side of your trade. Okay? You need to understand that. You need to, wouldn't it be nice to know if, say, a Goldman Sachs or a Barclays Bank or a big bank is on the other side of your trade versus maybe a novice retail trader? Wouldn't it be nice to know that? Well, we could do a pretty good job of getting there. So let's begin. And let's start with step number one. Give me 1 second here. Just want to adjust this cord here. It's giving me a little problem. Hang on 1 second. Can you guys hear? Okay, great. Hopefully that's a little better. So let's start with step number one. Let's start to learn how to identify these supply and demand levels. We can do a pretty good job of quantifying how much supply or demand is there also with the odds enhancement. So we'll have a little time to get into that today as well. All right. Look at the chart right here where I'm pointing. I know there's probably a little lag in the connection and pointing everything, so I'll take it nice and slow. Price is trading sideways here. Supply and demand appears to be in balance. Right? While price is moving sideways in this base up here that's labeled supply, we don't know its supply yet. I don't know if prices are going to rally out of that level, decline out of that level, and I really don't care. Actually, we can come close to figuring it out, but that's not what we're going to be talking about today. But so just hear me out. So prices are trading sideways, right? Supply and demand appears to be in balance. All of a sudden, however, there's a decline in price. Make sure you understand we are not trying to predict this decline in price. We're not trying to make money on this decline in price. We let this happen, right? We don't know that this is going to happen until after it happens. So sit back, nice and relaxed, and let this happen. Once prices do decline, however, That gives us very objective information for this level up here, which is now a level. Understand that the only reason why prices can decline from this level is because objectively supply exceeds demand up here. Okay. There's a supply and demand imbalance. Yeah, we'll get to that, Shank, with the odds enhancers. So once prices drop out of this level, this becomes a supply level. Okay. Based on a very specific set of rules, we wrap two lines around this level and carry this level forward, creating the supply zone or sell zone. Right? We want to know where the sellers are. Down at the bottom, just the opposite is true. Prices are trading sideways. All of a sudden, there's a strong rally in price. Once this rally happens, that's when we could say, aha, we now know where the real willing buyers are in this market, where objectively demand exceeds supply. Again, based on a very specific set of rules, we wrap two lines around this level, carry this level forward, creating that demand zone or buy zone. We want to remember where the buyers are. Okay? Another word for supply, retail prices. Another word for demand, wholesale prices. Let's move on. And just a side note, anything we don't finish today, we'll go over next time. So, all right. So now let's move on to step number 2, understanding who is on the other side of your trade. Okay. So another thing I noticed on the trading floor. Now let me just tell you what I would do on the trading floor. Where kind of all this came from is when I first learned of something called screen-based. First I learned of charts, that you could get charts at home. I started printing out charts and bringing them over to the trade desk every day. I would just figure out, I'd see the orders, if I had them, and I'd see the orders around us, where the big banks were buying and selling, and I'd put lines on the charts right there. And sure enough, prices would bounce from one side to the other. Okay. The only other thing I ever put on the chart was what we're getting into now. I noticed that retail orders that would come into the trade desk, or retail traders that would trade on the trading floor, would almost always lose money. They were really bad at this. I don't know, don't quote me on this, but it seemed like 8, 9 out of 10 trades that they would put on would be losers. And at the same time, I see that banks and institutions were right most of the time in their decision-making process and made lots of money. Retail traders were equally that bad, wrong in their decision-making most of the time, and lost quite a bit of money. So I started to track where retail traders would buy and sell in markets. And I put a little dot on the screen there when I see those orders come in. On the chart, I mean. And sure enough, it took about 2 days to see this very consistent pattern. In fact, it was the most consistent thing I've ever seen. Right? What we notice is, and it became pretty clear why retail traders lost money consistently. They made 2 of the worst mistakes that you can possibly make. Okay? They made two of the worst mistakes you could possibly make. Let's go over those right now. Okay, if we focus right here on the chart, and we focus specifically on the buyers, we see these are those novice traders. I see there's a couple questions. I'll get to them in a few minutes. Okay? These buyers are making the same 2 mistakes that every consistent losing trader or investor makes. Mistake number 1 they're making is they're buying after a rally in price. You would never do that in any other part of your life and be successful, right? Buying after rally in price. Think about it. When you buy a car, do you ever walk in and say, I know that car is only $30,000, but I like it so much I want to pay you $40,000 for it. You ever done that? Or the ice cream you buy at the grocery store, right? No matter how much you like the ice cream, do you ever offer more than what it's, than the asking price for it? Of course not. We would never do that. You would never do that. But why is it then that that's exactly what people do in the trading world? There's a reason. We'll get into it in a minute. Mistake number 2 is even worse. Not only are they buying after rally in price, but they're buying right into a price level where the chart already told subjectively supply exceeds demand. Okay? Almost guaranteeing a loss with that novice action. Prices fall as we'd expect, and down here at the bottom, if we focus on the sellers, it's that same group of novice traders making those same 2 mistakes. Selling after a drop in price, mistake number 1, into a price level where demand exceeds supply, mistake number 2. Instead of being that seller, okay, instead of being that novice seller right here, we want to be the buyer, specifically right here at this line, whatever price that is. buying right here, according to our rules, is the lowest risk, highest reward, and highest probability time to buy into this market. And that's the whole point of market timing. That's why it's so critical. Okay? It's the only way to attain the low risk, high reward, and high probability entry. Now, a lot of you have started out, like most people do, reading trading books or things like that, and I'm not beating you up for it. Okay? I'm not beating you up for it. I just want to expose some things so you have, my whole goal with this is to give you information and you do what you want with it. Process it in your head, and, I just want to expose you to everything and different ways of looking at this. And I want you, and I want to focus on how this really works in the real world. That's what we care about most. So let's talk about the trading books, right? Because understand that if you're not successful right now in achieving your short-term trading goals or your long-term wealth goals, whatever financial goals you have, it's ultimately for one reason and one reason only, okay? It's because you're thinking like a retail trader. Your brain is programmed from a very young age, all the way through your development years, the trading books, everything. You're programmed to think like a retail trader. Conventional technical analysis is the biggest culprit, right? That whole school of thought has people buying after a rally in price and selling after a decline in price. That is a retail move. My goal is to get you to understand that you're thinking like a retail trader and get you to stop doing that and get you to start thinking like the bank. Okay. All right. Anyway, so let's move on here. So let's look at this example from the retail trader's point of view. The trading books. Now, the trading books teach us don't buy here where I'm suggesting you buy because you don't know if there's any buyers yet. Right? Wait for confirmation. That keyword confirmation. It's in every trading book ever written. Wait for confirmation of a green candle like this, and then buy. But if we wait for that confirmation, that green candle, yes, you absolutely, you have confirmation. But what's now happened to your risk? Has it gone up or down? Yeah, it's gone up. Now, what about your reward or profit zone? It's gone down. Okay? So you can have confirmation, which may make you feel better, or you can have a low-risk entry, a low-risk, high-reward entry, but you can't have both. Does that make sense? Okay. Unless you shift your mindset and that word confirmation means something different to you than the trading books. Confirmation of someone selling after a decline in price into a demand zone, to me, that's the confirmation I want. Someone's making a big mistake there, right? The odds of prices turning are so high, the risk is so low, and the odds are stacked in my favor. Anyway, one more thing here, and then we'll move on and take this quite a bit deeper. Let's just, again, take a step back, because it's important that you understand how your brain works, how you make decisions when it comes to trading. And this isn't any, deep psychology or anything like that. But it's important to understand, why you make the decisions you do and why everybody does, the retail trader. Think about it again. What really hooked me into this business, and I'll tell you, it was really one thing and one thing only. On the trading floor, I realized that the gap between those who knew what they were doing and those who didn't was so wide. Those who made money, banks and institutions, and individual traders and investors, retail traders and investors, the gap, who lost money, that gap was just so wide. And I thought, you know what? I was pretty young at the time. I thought to myself, boy, if I could just learn what those guys are doing, those banks, maybe I can make that kind of money. Maybe I could be right most of the time. That make sense? So, but if you think about it, what are the average, again, if you compare the average trader and investor's returns around the world to the average Wall Street firm's returns, I think we'd all agree it's pretty lopsided. But someone tell me, what is the average trader or investor around the world? I'm talking about the average person out there. What do they do in the financial markets? What is the action the average person takes? Most people do what? They buy stocks, right? Isn't that what most people do? Most people buy stocks. Right? Yeah. Someone tell me this. So most people out there buy stocks. Someone tell me this. Wall Street does a lot of things, but what's their primary business? What's Wall Street's primary business? They sell stocks, exactly. So one group's buying stocks and the other group's selling stocks, and the sellers are making all the money. Now, I'm not at all suggesting you should stop buying stocks and start selling stocks. What I'm strongly suggesting is you need to start thinking like that group because they're laughing all the way to the bank. They actually are the bank. But it's too easy for that group, and here's why. How is that average person around the world taught or conditioned to, say, buy a stock, for example? Right? You all have the same lesson when you're a little kid in school, then middle school, then high school, then college, then books. It's all the same lesson, right? Make sure it's a good company with strong management, a healthy balance sheet. What about earnings? Are they supposed to be good or bad? Yeah, they're supposed to be good. And someone asked her this one. What about the trend of the price of the stock? We're supposed to buy it when it's an uptrend or a downtrend? Uptrend, yes. But there's the trap, okay? This is another major reason why most people are not successful. When all those 5 things I mentioned are true and good in that company or that stock, where is the price in that market? Is it at wholesale levels here on the chart, or is it at retail levels? Yes. Everybody on the planet from a very young age is not only taught to do this wrong, they're taught to do it backwards, and they don't even know it. Okay? And it's impossible for you as the FX trader to just come into the world of trading FX and not, and think that, oh, I'm not, you're not conditioned wrong. Everybody is. I am too. Okay? Our brains are wired backwards, and I'm going to prove it to you in a minute. So the good news is your competition, the more you start to think and trade like a bank, you're going to understand that your competition is taught to do the opposite. So again, everybody on the planet is taught to buy at retail prices and sell at wholesale prices in the market. All I'm suggesting you do is the opposite, which is what banks do. They sell at retail prices and buy at wholesale prices. Make sense? Okay. Easier said than done. Let's move on here. Okay. Let's take a look at there's another example I want to take you to. Give me a second here. Hang on. I guess we could use any of these. Okay. Let's use this one. It's fine. Okay. So let's start to put all this stuff together, and let's dive into some odds enhancements here. So here we identified a demand level, and if you look at the data, I just captured a whole week's worth of trading. We usually update this every few weeks. Okay. So Drew, we want to identify supply and demand levels, which means we want to identify areas on the chart where there are lots of unfilled orders sitting there. So take a look at this area in the chart. We identified a demand zone, right, where demand exceeded supply, right, where banks and institutions were buying. Over here is where we bought and profited from this trade. By the way, all these trades I'm showing you, these are all real trades. These are not hypothetical returns or demo accounts. So how do we know that's a demand zone? Well, let's go through it. First of all, we have the pattern, which we haven't gotten into too deep today. Prices rallied away from that level. Okay. But let's get into a couple odds enhancers here. How can we, I'm telling you that's a demand zone, advanced defining. How do we know that? Like, how can we be very confident? Okay. And to understand, too, when I say market timing, specifically what we're saying there is, just to be clear, the ability to time, right, to predict market turning points and market moves in advance with a very high degree of accuracy. That's what we're doing here. So, how do I know how much demand is there? How out of balance supply and demand is? Well, odds enhancer number 1. How did prices move away from the level? So would you say that's a strong rally in price? Okay. Strong rally in price or a gradual rally in price? What would you say? Strong. I agree with you. So what does that tell us about the supply-demand equation there? Small imbalance or big imbalance? Yeah, that's one clue that there's a big imbalance there. But it's just one. How about time? How much time did price spend at the level? A lot of time or just a little time? Yeah, just a small amount of time. I agree with you, just a little. So when the trading books teach us about those words support and resistance, which we do not buy into at Online Trading Academy, this is a very flawed school of thought. That's why you don't see people making money with it. When the trading books teach us about support and resistance, the lesson is always the same. It's, look for areas on the chart where there was lots of trading activity, many candles on the screen, above average volume, right? Okay, above average volume. But if you think about it, if you think the logic through, and don't take my word for it, think it through yourself, I think you're going to find that the opposite is true. For example, in any market, at a price level where supply and demand is most out of balance, which is what we're looking for, are you going to get many trades and transactions or very few? Many trades or very few at price levels where supply and demand is most out of balance. Okay. And to answer that question, or to help answer that question, let's go back here. Where on this grid, this is just supply and demand 101 here. Where are you going to get the fewest amount of trades? Out at the extremes, right? Most of your trades are going to happen right here in the middle. You're going to be lucky to get any trades off out here at 80 or down here at 10. However, that's where you have the most potential activity. But the reason why you don't get it is because all that potential is on one side of the market, the demand side and supply side, right? Buy side or sell side. So if we all agree with that logic, then what is that picture going to look like on the chart? Is it going to be many candles like all the trading books say, or is it going to be very few? Exactly, it's going to be very few. And that's the good news too. I mean, the trading books kind of teach you to ignore the levels that we want to look at. All right. So the fact that price rallied away in such strong fashion, the fact that there was very little trading activity at the level, again, those are two of a few more odds enhancers that tell us there's a lot of unfilled orders there. Now, whoever was buying there, did they buy all that they wanted to buy? Did they get all their orders filled? Right, no, they didn't. Okay, and we know that because prices would have stayed in that area. Again, I'm saying this is demand level. If that statement was not true and supply and demand were in equilibrium here, wouldn't prices just keep trading sideways? They would, but they couldn't. In fact, they stayed for a short period of time. So again, there's more to it than this, but just to get you an idea, that tells us demand exceeds supply there. All right, so banks on the buy side here. When prices came back to this level where we push the buy button, all right, this is where you want to push the buy button right here. Make sure you ask yourself before you push the buy button, who are you buying from? Is it someone who makes money or someone who loses? Is it the actions of a bank? Is it the actions of a novice retail trader? Okay. So, and keep it very basic. Go to the two mistakes. Is the seller who's selling to you here selling after a decline in price? Mistake number one. And are they selling into a price level where the chart already told us demand exceeds supply? Mistake number two. If the answers are yes, and the risk in this trade associated with the initial profit zone meets the minimum criteria you're looking for, we take the trade like a robot. Jake, no, you can definitely have a limit order in there. In fact, we encourage that in Online Trading Academy. Okay. Yeah, and Peter, as long as your supply zone, at least your area of supply up here is far enough away to give you 2-to-1, 3-to-1, 4-to-1, whatever you're looking for, you take the trade. Now, okay. Yeah, Francisco, I would say take time out of it. Don't worry about that. You'll find that when you're running into levels from a long time ago, those will be some of your best levels. For those that have been in FXStreet with me for a while, you've seen some of those really big ones from the past where we've hit levels from a long time ago. These are some of the biggest, best trades we have because by definition, if you're hitting a level from a zone from a long time ago, by definition, you're far out on the supply-demand curve, which means high probability and huge profit zones. Okay. All right. So now, I always am afraid that what I'm saying and sharing appears too simple and too easy, and I want to make sure and I want to be clear that of something. You know, like anything in life, when something seems too good to be true, it usually is too good to be true. I'm going to be 100% honest with you. This is definitely one of those things. Okay. And what I mean by that is this. I would say while the logic and rules for doing this properly are applying, a strategy are very simple, the act of doing it is not easy for the average person and will challenge you. Okay, yes, as Luke is pointing out, you definitely have to, the goal that you have to train your eye to identify these levels, and that's really what the odds enhancers are for. It's more of an exercise to train your eye. But let me get back to the point here. So while the logic and rules for doing this are very simple, the act of doing it is not easy. Let me point out a few reasons why. I already pointed out a big one a few minutes ago with the whole, what does the retail trader do, what does the bank do, and how they're taught and all that. But there's more. When we would push the buy button for this trade down here, what was the short-term trend in price, up or down? The very short-term trend. It's down, exactly. Have you ever read a trading book that says buying a downtrend? No, doesn't exist, right? Yet, that's going to be a downtrend on some time frame in every one of these trades when we buy. Okay. We also, we're looking to buy here on like the biggest red candle that you see on the chart. Would anybody be a little nervous buying when this big red footprint candle happens? Would you be a little nervous pushing the buy button? Remember, you don't see any green yet. Right? Gabe is saying totally. A lot of people are saying yeah. Yeah, and I'm not picking on you guys, but just understand, and I'm saying this because I care, the only reason why you're saying yes is because you're thinking like a retail trader. Because if I told you, if I said, you know what, this is not an FX or trading market, but this is actually the market for the Mercedes S-Class, right? And which is normally, I don't know, the S500, maybe normally about $125,000. Today on this chart, there's actually two, and they're selling brand new for $30,000. What are you going to do? Are you going to be nervous to buy? Who's going to be nervous? Or what are you going to do? Anybody going to be nervous? Craig's going to buy too. Then you're going to try to sell them to the rest of us for more, right? No, I'm just kidding. But, yeah, of course you're going to buy. And are you going to be nervous? Or are you going to be excited? You're going to be thrilled. You're going to buy those two, and you're going to call everybody you know and brag about what you just did, right? Okay. Let me tell you, that's exactly what's happening here, but people don't think like that because it's a financial market. The reality is how you make money buying and selling anything in life is exactly how you make money buying and selling in the financial market, but retail traders are wired, back. Your brain is wired backwards. The reality of what's happening right here when you push the buy button is you just walked in your favorite store. There's a sign right there that says your favorite item that you came to buy today is on sale for half price, and there's two left and they're in the back of the store. You're going to run. That's how you have to think about this. And I can tell you, I'll be honest with you, when people come and take the classes on Online Trading Academy, the initial class, they're not there yet. They're nervous. And we see it, throughout the week. They're a little nervous to push the buy button. But then they get into trading rooms, right, and things like that. I'm not pushing you to do this. I just want you to understand the process. After you do this for a while and get success pushing the buy button here, not only are you not going to be nervous anymore, okay, but you're going to start thinking completely backwards, completely opposite of what you do now. You're going to be excited to buy there, not nervous. All right. Yeah, Walker, that's really just a function of time frame, so don't worry about the colors of the candles at all. Okay, don't worry about that. Yeah, Drew, that's what we almost always in these webinars, we're looking at the live market. So we just set up trades that haven't happened yet. So that's what we always do. Today we're just taking a kind of a step back to basics. And let's go to another one here. Okay. So, again, right down here, prices are trading sideways. There's another trade we took, right? Yeah, DZ, that is what we want to do, okay? Right? But again, so DZ, are you saying why not buy in the yellow here and then make money when prices go up? Is that what you're saying? I want to make sure I'm clear on what you're asking there. Yeah, so good. So I want everybody to understand that. So what DZ is saying, why not just buy here in this yellow spot? And the reason why we don't is because how do we know that there's demand there? We don't. When prices are trading this yellow area, I don't know demand exceeds supply there. Okay? I don't know that until prices move away from the level. Does that make sense? But once prices move away from that level, as they do here, then I know, aha, demand exceeds supply there. There were a certain amount, there were quite a few buyers, on the demand side, much less on the supply side. As soon as that last sell order was filled here, prices take off like a rocket. But I don't know that until prices move away from the level. So that's why we wait. All right? But once we know that, then we wrap two lines around this level based on our rules. And when prices come back to this level, we want to buy at this line with our protective sell stop just below the level, and then our appropriate targets above, which we didn't get into today. Okay? Does that make sense? Okay. Yeah, prices will almost always come back to level. In fact, I don't think I've ever seen a level that prices didn't come back to. And the reason for that, again, if from the trading floor, is pretty obvious. I worked for a big, bank institution. We've got a lot of orders to buy here. We need to get those orders filled. Prices are going to come back because these are, our job is to get these filled. Okay. As someone who fills orders, you only get paid when the orders get filled. You don't get paid on trading, right? There's no trading profit there. It's, those orders are going to get filled. Okay. Good question, Walker. What do you do if all the orders aren't filled? I would say a good chunk of the orders that the orders that are really low on the curve and really high on the curve. Let me go back here. Right? These orders down here, these buy orders, and these sell orders up here, I would say most of those actually don't get filled. Okay? Most of those don't get filled. Some do. The lucky few do. That's why we want to use limit orders, right? But I would say most of those orders do not get filled. Okay. When you look at a price chart, let me just pull up the chart here just a second. Let me see how let me share this. Can you see TradeStation now? Anybody see TradeStation? Yeah, okay. If you think about it, the white space, there's a lot of white space on these charts, right? Okay. What's really in that white space? Lots of unfilled orders. Okay. So, again, the candles show us where, trades that have happened and where they've happened. Let me see something here. Let me kind of scrunch up here. Oh, the year is a good one to look at because it's really not a whole lot below. I know we've been saying that for a while, but let's go over the chart. Yeah, so ultimately, the euro, I'll show you. Move these up. Okay, so there's current price. Right, these levels, these areas here are not demand. These are all pivot lows. Price has been there. And I know it sounds crazy, but there's not a whole lot to stop the euro from falling to the 128.50. 128.25, right, to below 129. There's not a whole lot to stop the euro from falling to 129. I know there's a lot of stuff in here, but there's really nothing fresh. And we didn't get a chance to talk about that word fresh today, but that is a key word. We want to make one of the most important odds enhancers. Make sure it's a fresh level. In other words, make sure there's still lots of unfilled orders sitting there. Okay. Hopefully that makes sense. Okay. There's my email address, sseiden@tradingacademy.com. I know I missed some questions today. I really wanted to focus on getting the basic lesson out there, and it's tough to do. Impossible to do looking at the live chart. Want to take a little break from that. We'll get back to that soon. I wanted to go over the basic lessons, so hopefully we got the basics out there. We have more webinars coming up next month or this month, and next session we'll break it up into two parts. We'll get into some odds enhancers, and then we'll go into the live markets and start to apply this. So hopefully that was helpful, and it's really all about the basics. All right, thanks everyone for spending your time, and have a great day. See you next time.